Well, folks, it's open season yet again, and before you say, Thiago, we're okay with our current selections, I encourage you to take the next 5 or 10 minutes to hear about some really important factors that might make you rethink about your current elections. Most of you have been feds for a while and might think that your coverage is fine. And while that might be true, it's always best practice to think about whether your current financial products are best suited for your needs. OPM gives us a lot of great information, but it's up to you to make the financial planning decisions that are right for your family. So here's what we're going to cover. What every Fed should be asking themselves about FEHB, how you should be thinking about life insurance or FEGLI, and some potholes to watch out for, how to address the huge risk of long-term care, some factors for dual Fed families, and if you stick around till the end, I'm going to tell you how you can get our free annual open season guide for federal employees. So let's jump right into FEHB. First of all, you should know that the overall average of the increase in premium for enrollees is going to go up by around 7.7% next year. This is due to the overall rising costs in healthcare and health insurance. So obviously you want to make sure you're selecting the right plan so that you're not paying hundreds of extra dollars each year for no good reason. So what kind of plan does make sense? There are tons of options, and the guide we'll hand out at the end will cover specifics of each. But I want to talk about some things that you can be thinking about in the interim. For someone who is relatively healthy, rarely injures themselves, and are generally only going to doctors for checkups, then you may want to consider getting a lower coverage plan. This is going to let you save pretty significantly in premiums on an annual basis. An example of this might be a high deductible plan, and with that you can get HSAs, which are just an incredible type of account. Now the thing with this is that you do need to make sure that you have a good emergency fund in the event that you do have some higher medical expenses and need to cover those out of pocket. Now, for someone who has some greater health challenges, perhaps you consider going with a plan that has a little bit better coverage. This does mean you'll pay more in premiums, but overall your costs may be less for the year. This is especially true if you are expecting to need a specific kind of medication or a certain kind of health care in the following year. Want to check to make sure that your current plan covers what you're going to need, and if it covers it this year, make sure it still covers it next year. Health insurance plans often change from year to year, so you want to make sure what was then is still true today. This will help you prevent getting a surprise bill for your health care. Remember that you can have 1 year of higher coverage and other years with less coverage. That's exactly what open season is all about. It gives you the flexibility to change your plan as your life changes and as your needs change too. You also want to make sure how becoming eligible for Medicare, so being 65, impacts your choices. Medicare often pairs well with FEHB, and if you're on TRICARE, you're required to take it at 65 when retired. And soon we'll be releasing an update of our Medicare vs. FEHB video, and so if you're not subscribed, make sure you do so now because there's going to be a lot of good information in that video. All right, next up, life insurance. Life insurance can be a complex topic, but here's what you need to remember. The primary purpose of life insurance is income replacement. If losing an income would be tragic to a family, then life insurance is important. But what if you're about to retire? It can still be important, and here's how. When retired, you have the three-legged stool that many federal employees know about: Social Security, your first pension, and your portfolio. Well, if a Fed dies, the surviving spouse only gets to keep one Social Security, whichever was higher, theirs or yours. Plus, at least half of your first pension is going away. Now, if you're late in your career, or maybe you're retired and you've been a really good saver, then maybe this isn't as tragic as to someone who might be younger. But the point is, you shouldn't automatically assume that you no longer need life insurance. If you've not done the financial scenario modeling that shows your death as soon as you retire, then you really can't be certain about the long-term impact of losing that income for your family. So the lesson here is make sure you're doing the right kind of planning. All right, now let's talk about long-term care for a minute. The Department of Health and Human Services talks about how 70% of adults over 65 are going to need some level of care before they die. Folks, that's a huge number, and you need to be modeling this in your retirement plans. Can you afford this type of care on your own? Do you want to or need to pass on this risk to an insurance company? The Federal Long-Term Care Insurance Program recently sent out premium increase letters to everyone who's currently enrolled in the program. And if you've gotten that letter, then you know that the price increases are pretty steep. And there's a good reason for this. People are living longer and the cost of care and insurance is rising. So insurance companies are having to increase the prices just to keep up with costs. Needing long-term care later in life is a huge risk to a retirement plan. And sometimes it can be the reason that that retirement plan fails. And the problem with standard long-term care insurance is that you can expect the price of these insurance policies to pretty much continue rising for most of your life. This makes it really hard to plan for these expenses, and we've seen them become so expensive that sometimes people have to reduce their coverage or drop it altogether, because the alternative was going to be having to make real difficult decisions about their lifestyle. So what's the lesson here? If you're in your 40s and 50s, now is the time to start thinking about long-term care. The older you get, the more expensive it gets. There are policies in the private sector that allow for that premium to stabilize. This helps you budget for them more easily, but you do need to get these policies earlier so that they're cheaper. Now, I'm not an insurance agent, but we do cover insurance planning heavily with our clients because it's very important. So I recommend that you go and speak with your advisors about what's appropriate for you. All right, guys, next up, we've got dual Fed considerations in our annual guide. But before that, is there anyone in your agency that you think might find this video helpful as well? If you can think of someone, consider sharing this video with them and hitting the thumbs up for us. Next up, if you're married and your spouse is a Fed too, then there are some specialized tips for you both. First, consider whether it makes sense for you to have 2 individualized plans instead of one self plus one plan. If one member needs a higher level of care, then it might make sense to get 2 individual plans, with only one of them being the more comprehensive and expensive plan. This lets the person who doesn't need as much care have a cheaper plan to help you save some money. The next thing is that if one of you is retiring sooner, so either there's an age difference between you, or one of you is just reaching your eligibility prior to the other, then you may want to consider switching to the FEHB program under the active federal employee. The reason for this is that when you're working, first you get paid, then they take out FEHB premiums, and then they tax you. But when you're retired, it's backwards. First you get paid from your pension, then they tax you, and that's when they take out your FEHB premiums. So essentially, when you're working, you're getting tax-free health insurance, and in retirement, it's no longer tax-free. The amount you pay is still the same, but now you're also having to pay taxes on the amount of your FEHB premium. It's not a massive difference, but every dollar counts. You could essentially have a 20 to 30% higher cost to your care simply because of this dynamic. All right, folks, like I promised, here's how you can get a copy of our free annual open season guide. We're gonna put a link in the description box below the video that you can click on, and if you subscribe to our newsletter, you're gonna get an option that lets you download our free annual guide. Our clients love it, and I know that you will too. Once again, I'm Thiago, and if you're curious about how we're helping our clients have better retirement plans, check out our website at thefedcorner.com. And until next time, stay wise and stay wealthy.